Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
All right, welcome to Real Estate Risk Report. Today I have with me Ben Appleby with Dogwood Commercial. How you doing, Ben?
I'm well, Lance, and yourself?
Doing good, man. Really good. So today we asked Ben to be on the show. He specializes in office, which we'll cover here extensively, kind of as the theme for today. He also operates, quite a bit in the Dallas-Fort Worth markets, which he'll share a little bit about those markets as well. So, but why don't you just kind of give us the high-level sort of view about yourself and your firm?
Yeah. So I am from Dallas, Texas, born and raised here. Grew up not very far from where I live now, and after high school went to the University of Oklahoma, and third generation Sooner. Excited for football season again. When I was looking to graduate, I really wanted to go into branding, go into the marketing or PR spaces. Because I've always had a real passion for rebranding things and taking something old and giving it something new. And then I saw what they paid kids coming out of school to go to New York or Chicago for those jobs, and the capitalist in me kicked in. And so I came back to Dallas and started interviewing in the commercial real estate industry, and I got an internship with a publicly traded REIT called Duke Realty Corporation, and was told that it would be a 3-month internship. And I was lucky enough to turn that into 6.5 years at Duke. While there, I got the opportunity to start the Suburban office development division. At that time, Duke only did industrial in Dallas because, as the newest office nationally, the gentleman, Jeff Turner, who ran that office, he had only been an industrial guy. And so I approached him about 3 months after I got my full-time job and told him that I had a real passion for suburban office. I'd been driving in the northern suburbs, and all these value office buildings just look like our warehouse buildings with windows punched out. And I said, I know that probably puts me out of a job that I've worked really hard to get, but that's what I'd like to do. And he gave me the opportunity to go out and buy land and start building office buildings. And so that really started my love of suburban office. After 6.5 years at Duke, I went to help grow and run the Dallas office for a company called PM Realty Group, which is now called Madison Marquette. And started growing that business unit in more institutional product. That's the world that I had come from. But during my time there, I saw this wave of private equity coming to Dallas-Fort Worth and really concentrating on a lot of suburban office. And so I started focusing really intently on growing our suburban Class B to A- portfolio with private equity clients. I found that I enjoyed working with the private equity clients a lot more. Institutional clients were, they wanted all of our time and half of our money, I would say. And I've since, they're not all that way, but it was exciting, right? You had all this fresh money coming into town, coastal money from Mexico, money from China, and they didn't know anything about office. And so it gave us a great opportunity to come in and instill our brand of aggressive, transformation and in pursuit of market share for these clients. Really exciting. About that time, I had developed a model for how I would train young real estate professionals, and I had a really clear service model that worked. And so I decided to start my own brokerage firm in 2014, and that's all that it was supposed to be. It was just supposed to be a brokerage firm. And so I hired 2 young guys straight out of school and started training them up, and we started attacking the Class B to A- suburban office portfolio. That product was too small for the big boys, for the national firms, and it was usually too complicated for the small companies. It's a product where you got to know what you're doing. You got to know how how to go and grab people out of their buildings and make them look at the product. So after 2 years, we had grown that team to 5 brokers and 3.5 million square feet of Suburban product under our leasing platform, and another 3 guys doing tenant representation. And I saw the price of construction starting to go up at a real rapid clip. This is early 16. And it was going up at like 8% annually, 15, 16, and it was projecting for 17.
What was driving the cost of construction going up?
Well, at that time I didn't know, but when I really dug into it, what I found was the way that interior GCs procure their materials and pay their subcontractors is a broken system. And I have the unique background of being the son of a tool salesman and tradesman, and all of my dad's clients were mechanics, motorcycle guys, airplane mechanics, all tradesmen. And so that's, when my dad would have clients over, instead of, it wasn't a white collar sit down around the table. It was everybody hung out on the back porch and just chatted about business while my dad cooked steaks. And it was awesome, really. And I got the great opportunity to understand the mind of the tradesman growing up, really inundated in that world. And so I looked at 8% growth in construction and traditionally, let's call it 2.5% to 3% growth in suburban office rents. And I just said, something has to give here. At some point, the construction costs are going to go up so much that suburban office owners are going to say, the returns are condensed too much. We're gonna put our pencils down until something normalizes here. That was my fear. So I decided to start a general contracting company. And the thesis of it was, I'm going to establish direct relationships with manufacturers. I'm going to set up my own logistics channels to get the product here. I'm going to buy in bulk, and I'm going to pay my subs every Friday. Because what all the interior GCs in Dallas-Fort Worth were doing, they pushed the responsibility of buying the materials on the subs. Now, subcontractors are smart, and they also usually, tradesmen in general, are usually in a position where they don't have a ton of on-hand cash to go and buy materials. So they make the trades, buy the materials, they go buy them retail at the highest possible price that you can. Then they don't pay those guys for 105 to 120 days, 30 days after they get paid. It's usually when a subcontractor will get paid. So you're making subs float the cost of materials and labor for 105 to 120 days. Those guys are smart enough to bake that in. And so we had a little bit of material price increase, but there was a bigger competition for labor. We had a lot of relocations to Dallas. We had a ton of multifamily development. And so the labor is all getting snatched up, and the way that people are being paid and the way that the materials are procured is a broken system. So it was an expensive way to start a company, but I said, I'm going to buy the materials in bulk. I'm going to get them here through my own logistics lines. And I'm going to pay my subs every Friday. And what I found was that, when I would go through the competitive bid process on jobs, on average, I would beat the competition by 22%. So the next lowest sub or the next lowest GC would be on average 22% higher than I was. And I was still making a nice profit on that work. And I had really loyal subs. I could get the absolute best labor in the market because they knew they were going to get paid every Friday. At the same time as that was going on, one of our clients asked us to get into the property management business. And obviously starting a brokerage firm and growing that and then starting these 2 companies at the same time was a pretty active and stressful part of my life. But I went to him and I said, hey, I'm starting this other company right now. I don't know that I have the capacity for it. They said, well, how about we give you 700,000 square feet to start out with? And I said, we're in the property management business. So we went out and we worked really hard and found the right people to build out our team and started growing that. And so in early 17, I woke up and we had a vertically integrated asset services supply chain. We could do the strategy, we could do the construction, we could lease it up, we could manage it. We could get people from acquisition to stabilization and either refinance or sell the entire process in-house. And so that's what we really started doing pretty heavily is helping people buy broken assets, setting the strategy, executing the construction, doing the brokerage and management, and then, getting them to a point where they could return capital to their investors. One of the frustrating parts about seeing kind of behind the curtain is seeing how many sponsors would have me sell their investors on their plan, and they would execute somewhere between 50 and 70% of it. They would get in and they wouldn't make decisions fast enough, and debt service, they wouldn't start the CapEx process till 6, 9, 12 months after acquisition because they weren't prepared. We would try to get them to make decisions. They'd want to, for a number of reasons, just delay that process. And then when it came to spend money on the things that were really impactful, they'd be like, oh, well, if we don't spend that, we can return capital faster. They would talk themselves into shorting the CapEx scope. And it was very frustrating because I would watch folks that had made great acquisitions, great basis plays, do one or two things that would really affect their ability to drive value and affect the speed at which they could return capital to their investors. So in early 18, I got an opportunity to, I met a gentleman who had started a private equity firm. He had sold half of a multifamily firm, and we got connected, and he said, I'd like to partner with you. So we did 3 acquisitions that entailed 6 buildings in a joint venture, and those assets have done very well. It gave us the first opportunity to have control over the strategy and then 100% of the execution, the speed, how prepared we were going to be at closing, how prepared we were going to be at every step, working with the manufacturers to make sure that our materials are there and there's no lead time delays, and working with each of our tradesmen to set out really specific sequencing schedules to make sure that we were tight. And what I found was, whereas a lot of our clients would lose occupancy during the CapEx period because it took them too long. And if you take a long time and you tear apart somebody's building, you're going to lose people. Yeah. What I found was with really efficient execution, when we go to the tenants during our due diligence period and say, here's exactly what we're going to do, here's how we're going to do it. It is going to be noisy. We apologize in advance, but we're going to do it fast, and you're going to have a fantastic product. If you execute on that, we actually grew our occupancy on each project in the middle of our CapEx significantly, because those folks would tell their friends, and their friends in EO, their friends in YPO, their friends in wherever. And so that momentum really started growing in 2 ways. Number one, it was the organic growth, the word of mouth growth with the existing tenants. And then kind of going back to my brokerage model, I do not allow our brokers, any of our producers, to just put a sign out and rely on CoStar to bring their leads. I mean, there are a number of, and this is just our programmatic system for brokers, but a number of direct marketing channels. I mean, I want you walking into buildings and selling these people on, you are not getting what you deserve here. You are paying X for this building. Right. Give me 15 minutes. Come over here and check this out, and here's going to be your rate, because we bought, we got a low basis, and we stretched our capital dollars because we own a construction company. Yeah. We've been really mindful about how we execute, adding amenities and going for convenience and customers and your employee satisfaction. Like, if you aggressively go after folks, they want to be pursued, right? Yeah. And so our brokers do a really great job of just kind of, like I say, I want you to put a vacuum hose on that building and that building and that building and go take the best of what they have. Right. Because they don't know what their product's worth. They price it too high, and they've forgotten how to spend capital. We can beat them every day of the week. Yeah. So,
when backing up a step, like when you were referring to, like you said, like your clients before, they would come to you and then they were too late on executing like the strategy and the renovations and things like that. Like, but were they coming to you in your role what role were they coming to you as? Was it as the general contractor, or was it as the the leasing agent, like, because you have the vertical integration, like where are they seeking that consultation? Is that they're like, hey, you hear this building's for sale and they're going to buy it, and then they come to you as the potential leasing agent, or how does that work?
So what I did quite a bit in the last half of 16 through middle of 18 was I would identify an off-market opportunity and I would take it to a capital to a sponsor. And then I got to know a number of private equity, Dallas-based private equity groups. And so then those guys would start, like if somebody brought them a deal, they would say, you need to work with Dogwood. You need to work with Dogwood and GCS, which is a construction company.
Yeah.
And what I learned is that you can lead people to water. You can make it the best water in the world, but you cannot make them drink. And the number one mistake that folks make when they get a great basis asset is that they don't spend their due diligence and closing period effectively at all. They just say, okay, we're going to get this one done, and then we're going to figure it out once we close.
I see.
You need to use that time. I mean, that I would argue that pre-close is the hardest that you will ever see our collective machine work, because we are setting every domino up, right? We are getting the plans done, spending a lot of money pre-close, getting the CDs done, getting the materials ordered. And it's not, the CDs aren't much. Our suppliers, we have good enough relationships where they're not going to charge us for it until after closing, but we are going to set it up so the materials are here in Dallas, the plans are into the city and hopefully with permits, and we know where every dollar is going to be spent. And if you start that process after you close, and then, sometimes, one example, a client of ours bought a building close to LBJ and the Tollway in Dallas, which is an area that we've actually purchased 3 buildings now. This is back in 17. And the equity group brought me to the table and they go, Ben, this is the most uneffable deal ever. And I was like, oh, don't tell me that, like that's pretty high praise from some smart guys. Yeah. And I said, all right, so walk me through it. And so we meet in 30 days before closing. I said, okay, here's the team. Here's the space planner. Here's the contractor. Here's how everybody's going to work together. I laid it all out and they go, yeah, we're not going to, we're busy with some other stuff. Let's figure that out later. At closing, hey, here's the team. We've got a meeting set for next Thursday. Well, hold on, time out. We're not so ready for that. We're going to bring in some consultants and we know this guy that just did 2 Class AA projects in Uptown and these contractors that have worked on these beautiful projects ground up. And I said, well, those guys are really talented guys, super talented guys. They're super talented at urban AA projects. They do not know how to stretch capital dollars on a Class B repositioning project in the suburbs. And I would advise that we not bring them in. So they bring these folks in a year later. We haven't even started CapEx. And once we get started, they want to go and spend money in these goofy places. And I finally had to resign off of the job because I couldn't watch it happen anymore. So fast forward 24 months into the hold, they bought it with a $52 basis at 30% lease in a really great location. 24 months later, $108 basis, 30% lease, because every ounce of leasing that they did, they lost, renewing tenants. And it just goes to the importance of be prepared and execute exactly what you say that you're going to do, and report to the tenants like you report to your investors. Let them know exactly what's going on. Our property managers send out an email every Friday afternoon and every Monday morning telling the tenants exactly what's going to happen that next week with the capital, with the CapEx, with the construction in the building, with the construction outside of the building. If there's any parking garage, if we need to shut down the parking garage for a weekend,
yeah.
They are stakeholders in this process. Do it and do it fast. And so that's.
Yeah.
Sorry for the long explanation. It's
no, but it makes a lot of sense. I think that the assumption, from most passive investors would be that everything you just said was I would have assumed that's what everyone did, right? I would assume that when, they identified the project, obviously you want to get in at a good cost basis. I think that goes without, saying. That's what we hope everyone is doing. But then you also assume that that you've got a plan, like, and that you're going to immediately begin to execute said plan, especially when it's, a value add play. I mean, it's one thing if it's, 100% occupied core plus, it's a stabilized asset, that's a different game. But if you're in the value add kind of band, I would have assumed that would be the case. So it's really interesting to hear that. So, I mean, I think, in general, given that, we're here to sort of talk about these risks, which I think many of the things you've kind of touched on kind of point to, risk one being that I think you highlight is just time, right? Time is a big deal. But in terms of like the big categories, right, today we'll kind of talk about, the risk of physical obsolescence, which is really what generally would lead to a value add play, right? What are the property specific risks? Obviously credit risk that you're exposed to with those who are, signing these leases, liquidity risk, which would really be a function of how do you get out of this project? I mean, who's going to buy it from you after you execute the strategy, and obviously just making sure you got enough cash on hand to weather, any downturns or whatever, and, debt risk, just how you structure it obviously is a big deal as well, and can expose you. So those are the kind of high level areas we'll kind of touch on today. But I think starting out at the notion of how real estate cycles, right? And how an asset used to, be great, now isn't so great. And I think that, you correct me if I'm wrong, but that's sort of where, an asset built in 1985 might've been Class A when it was built and brand new. And it makes its way from, if it's neglected, from an A to a B to a C. And is that sort of how it works? Is just these things, as time goes on, they kind of cycle in and out of these things, and that's what creates the opportunity.
That is exactly how it works. So if there wasn't a large number of office owners and sponsors that have forgotten how to spend money on their assets, then we wouldn't be in the business of buying real estate. So our criteria really are, we have very specific areas of Dallas that we buy in, along major thoroughfares, great locations, great median income statistics, great average, median age statistics. If it's in the suburbs, the public schools are really important. If it's interior inside the loop, the private schools are really important. So we look at all those things, but then we look in those areas and we say, what are the assets that are most broken with the most opportunity? So you look at somebody who's owned an asset for 15 years and they haven't spent $1 on the asset. And so you have all fluorescent lights, really dark interiors, old nasty restrooms, no amenities whatsoever, but you're in an area with high median income, with people that would love the convenience of being at that asset. That's a green light for us, because what we do that's a little different than what others do in the value add game. A lot of people will try to take something from a B to a B plus or a B minus to a B. I tell our teams, we're in the business of full letter jumps. So if it's a B when we get it, it's going to be an A when we're done with it. If it's a B minus, it's going to be an A minus. And so the way that we structure our loans, the way that we, put together our budgets with CapEx dollars and all that is very, very important, because we have to have the proper amount of capital for us to bring a real fresh energy to the building. All LED light replacement. We're always redoing the lobbies. We are always redoing the restrooms. We're always redoing the corridors. We're always adding gyms with locker rooms. We're always adding large conference rooms. We're always adding tenant lounges. We're always replacing the exterior lighting with LED. We're always adding security cameras. We're always adding physical security. Like, there are some things on every project that we do, because these are the things that people don't see any value in. Mm-hmm. And the people that don't see any value in them happen to not be the people that are actually occupying space there. So, these owners acquired these assets at a time when emotional needs were not as weren't as big of a part of the consumer decision-making process. And also when amenities and, convenience weren't as big of a factor. And so they take that same mindset and they lock it in from 2005 to 2020. We're going to take the same approach to this asset, regardless of the tremendous change that's happening in society. And, when we started buying buildings with our partner, and now we've closed on one as the sole GP, we got another one under contract. What we shifted to, two big shifts that happened that have helped us out tremendously. Number one, I tell our folks all the time, if you concentrate on the emotional needs of the end user, then the price is not as big of an issue. If you focus on the two biggest ones right now are convenience and their employees' satisfaction. So if from the very beginning, from the very genesis, we focus on making our assets the most convenient for the biggest target market, and these assets are all about employee satisfaction for their employees, then we are going to catch a lot of fish that way. Mm-hmm. The second thing, and this is a huge element of being someone who comes from the service industry side and getting into the sponsor side. The day that we closed on our first asset, I took the investor list with real human beings with real amounts of money, and we had an all hands on deck meeting, and I blew it up and I put it on the wall and I said, these are real humans and these are real amounts of dollars, and we are the stewards of this money. Like whatever we thought we were before, we were service providers. We are stewards of people's capital now. And I think it's a testament to our teams, but everyone has gotten not just a little bit, but a lot better at what they do because their passionate pursuit is different. Yeah. We are stewards of capital now.
Yeah.
And it helps us tremendously with our third party clients, just as it does with our own, the property that we own.
Yep.
And so kind of changing that mindset for us, it took time. It was hard. I understand it's a difficult process, but we look for situations where these owners of office, they have forgotten how to change their mindset and how to meet people where they want to be met. And they've forgotten how to be good stewards of capital, because when those things align, those are usually assets that we can basis really well and we can execute on.
Yeah, no, it makes a lot of sense. So, I mean, for you, it sounds like you've got, a very tight box, and, I'll go on a limb, assuming your theory there is just that you're not stretching. There's always going to be demand. I mean, but how do you assess that in those areas, like in terms of supply and demand? I suppose the construction costs, new buildings and permits and, those sorts of things. What's stopping someone that you buy this building and then someone shows up and builds something that's even fancier and better and more on point than what you've got? I mean, how do you assess that? Is this something you guys are constantly paying attention to since you're on the leasing side? I mean, yeah.
Every day. So I'll say this: each of the assets. So this next one that we're closing in October will be the 8th building in the fifth closing. Our entire package between our acquisition and then our CapEx, our TILC, our closing costs, the fully baked basis number after everything's executed is always right around 50% of replacement costs for that asset. So we hedge hard there. Like if we're too far above 50% replacement costs, we can go a little bit higher, but we're never going to get even close to where somebody can come in and develop new and compete with us.
Got it. So that's a huge part of what you do. Like that's
huge.
Yeah.
Huge. And what it requires us to do, and there's two channels at which I approach this, but you gotta search hard for the right opportunities. I mean, people will jump at things just because they look at an NOI number and they say, well, we think we can grow it this way. And they take they hunt with a shotgun. Mm-hmm. And I like to say we hunt with a rifle. Like we have to be super granular about how we approach these things so that we can find the right basis number so that it's something that doesn't have, a ton of deferred maintenance where it eats up all the capital that we need. Like I call them pretty dollars. We have to have a lot of pretty dollars. Okay. If we buy an asset that has that we can only stomach $2 million of capex, and it's got $1.4 million of deferred maintenance. We have very little money to actually go and execute the plan. We can't reposition that building with that amount of capital. And so, I'm doing a lot of behind the scenes, as are a couple of our team members on, okay, we're talking to tenants. Do you have hot, cold issues all the time? Do the elevators work? Like the big mechanicals, we got to make sure that there's not an oops there. And if we know about it, then we've got to price it in. And so, we do a lot of background on these assets while I'm cold calling these owners. I've got this formula that we built because I'm a super geek, where we'll go and get the loan documents from when the asset was purchased. Yeah. And then we look at the historical rental statistics and the vacancy at the time, and we track the vacancy over time and use new dollar TIs for the new deals that they make and re-tenanting. And so what we get to basically is we try to figure out within a plus or minus 5% at what occupancy level, when they dip down, do they go from black to red. So it's been kind of an evolving model over the last 4 years, but it's pretty accurate. And so when they're within 5 occupancy points of where I think they're going to go from black to red, I start calling, because I know one thing for sure: they're not going to change their stripes. They're not going to instantly start spending money on these assets. They don't care about the tenants. They do not care about the tenants. Okay. So they're not going to care enough to spend money. So I'm going to call and call and call. And I know at some point between when they hit break even to, 5 occupancy points lower, they're going to start listening. The other thing that I'll do is I will, if an asset is marketed like through traditional channels, and I like this asset, I think it's something that we can execute on. But the whisper price is always astronomical for these things. They come out with these, these OMs, and it may work for Core Plus and more, in like some of the top 2 or 3 markets. But when they bring out a broken Class B asset, the whisper price is always high. And so I will wait exactly 3 days after best and finals are called, and I will call the sales broker, and I will say, hey, so who'd you go with? Like, who are you going to sell it to? And I know the answer. It's that they didn't get their number. And so that will lead me to saying, well, do they need to sell? What's the situation? Would they consider talking with me about a price that could give them a graceful dismount, but it still gets us the basis that we need. So using those 2 channels, and a lot of background work from our brokers, from our managers, from our construction guys, we will identify the appropriate assets that fit our model. But I would say that, 80% or more of the assets that we look at, we choose not to pursue because of one of the many reasons that I've already mentioned, that, you got to replace all the HVAC and they won't sell for less than X. And so now, if I allow basis creep to get out of control, or even we have got to be incredible stewards of those dollars. We have got to stretch capital dollars better than anybody else. And so that requires us to be really, really, really prepared when we even enter into a conversation about buying something off market or after it's been marketed. We have to know exactly what that number is and how many pretty dollars are going to be left over with after deferred maintenance. Mm-hmm. So I just think, it's something that we take very seriously. And I think a lot of people that do this, if you look at the statistics across the last 10 years of Class B repositioning projects, the statistics are not great in Dallas County, Collin County, kind of the west half of or the east half of our metroplex. Take Fort Worth out of it, totally different. The metrics aren't great. Our metrics are great. The overall metrics are not great because people don't know what they're doing. They look at a basis and they fall in love with the basis, and they don't think about what does that basis come with? What are the strings attached here? Oh, we got to replace 3 elevators and 2 chillers. Okay, well, now your basis isn't so hot anymore.
I see.
so many people fall in love with the basis, or they fall in love with the story, the surrounding story. Well, I mean, I got to underwrite a building as if that $2 billion development that's planned across the street doesn't happen, because more of those things don't happen than do. And so it's something where you have to think through all these. There's no detail too small when you're assessing a Class B repositioning opportunity, but when the stars align, and I'll tell you what, the reason I can be as granular about where we look and what we look for is because the pond is pretty deep. Okay, there are a lot of people that own 80s vintage, 90s vintage, really well located office that have not invested any capital in it, and so we can be pretty selective right now. I know that it won't be that way forever, and so I've been spending a lot of time in San Antonio and Oklahoma City and looking at Little Rock. There are some markets that, for different reasons, each of them have fundamentals that I think would be very receptive of our asset repositioning model. But right now, there's enough to say grace over in Dallas, Texas, for a number of years, I think. Yeah,
and it's from the outside looking at it, I haven't spent a lot of time in Dallas, but it sure seems like, between this, the pandemic and, all these various things that are going on, that there's a lot of movement from the coasts to Texas in particular, in migration and those sorts of things. So, now you have that. And then of course you have, the knock-on effect of the pandemic is just, is office dead? Those sorts of things. So maybe give a little bit more color. I know you've lived there pretty much your entire life, but what makes Dallas a great place to invest in? Your asset class in particular, but it seems like it's got a lot going for it, but maybe add some more color to that.
Yeah, I'm a huge fan of Dallas, Texas, so maybe a little bit of a commercial, but I coming from the development world and working for a Midwest-based publicly traded REIT, I got the experience early on of having to take my projects at a young age to investment committee, and I learned a lot through that process. And what the biggest thing that I learned was know the politics, know the demographics. If you're just taking a deal to a publicly traded investment committee, you're saying, look at all this flashy material and all this, these guys will eat you alive. Mm-hmm. And so what it got me doing very early was looking at the political makeup of the state of Texas, of North Central Texas, of demographic movements, of rankings of public school systems for the suburban markets, for each ISD, for median age, for where are people relocating in the nation? Will that change the political makeup of the state? So some of the things that make Texas very attractive is we have quorum at the state legislature without one Democrat present, which means we're heavily weighted on the Republican representation of our state senators. And regardless of your politics, that will foster a very attractive environment for big business, for business relocation, protecting business owners and both small, medium, and large to operate here. Also, one of our previous governors, Rick Perry, was a little bit of an economic development savant. It's not very widely known, but he started the Texas Enterprise Fund and really brought it to prominence. I remember one of the first deals that I did on my first development is we recruited T-Mobile to put their regional headquarters in Frisco, Texas, on 70 acres that I had acquired. And so we were working with that municipality and with the county on all the incentives. And then at the last minute, and we kept talking to the Texas Enterprise Fund, and they said, we're not ready. Well, as soon as it was official how much the city and the county were giving us, they came in with $100,000 more. And so they just want to see, how can we one up the city and county so we can be the primary, funder. So that still goes on to this day. The Texas Enterprise Fund is alive and well. The economic development corporations in North Central Texas are aggressive. There is such a competition for for not just large tenants, but medium-sized tenants, for the small bit, for incubators, for small business. So it is an extremely business-friendly environment. That helps, number one. Anytime you have a correction, which is what we're going through right now, I've seen both in I got into business in May of 2003, where it was crickets. The effect of 9/11 was still very present. So getting into business in that time, and then living through 08, 09, 10, 11, what I found was that the small to medium-sized business community in North Central Texas is extremely resilient. These folks do not have an option. Like, while the large companies can lay off their staff, and it's kind of a CYA at the decision-making level, these small to medium-sized businesses, it affects their livelihood. They have to keep going. They have to figure it out. And we have a very resilient, figure it out environment here. And when you look at the history of Dallas, it's a relatively young town, just number of years, but a very entrepreneurial town. Trammell Crow and Lincoln Property Company, both founded here. And you could go on and on with the well-known national real estate companies that were founded here. So I do believe in the entrepreneurial spirit of North Central Texas. That's one thing why I love Class B. Like, I had people in 18 and 19 saying, well, you're buying late in the cycle. Why are you so confident in Class B? I go, because Class B doesn't do fantastic in the hottest of times. Class B is pretty flat when things are really hot, because everybody's going to Class A and Double A and going to the uptown and the real urban areas, because it's a competition for labor. Where Class B really wins the day is right now. The tenants are smaller. You have less exposure. The small business community around here is fantastic. And I call them up and down buildings. So another part of the secret sauce is we have to basis our buildings after everything is spent, so that we can go and charge a rate that is between $17 plus electricity and $28 plus electricity, because above that and below that are the two things that just get slaughtered when there's a correction, because everyone moves to the middle. The guys that are in Class C can afford a nicer office. The guys that are in Class A, Double A, those decision makers, if they don't get into something more reasonable, they're going to lose their job. When unemployment goes up, you don't have to compete. The excuse of going and getting $60 a foot real estate to compete for young talent is not a thing anymore. Yeah. You can go out and hire, you can throw a rock and hire, 10 young folks coming out of college. So there's a lot of thought that goes into the type of product that we buy, but a lot of it is it's just anchored in understanding the demographics and understanding the historical trends. And so long as the state of Texas, the state legislature continues to protect big business, I do believe in suburban home pricing is still really low compared to other major MSAs. Yeah. North Texas will continue to get its fair share of relocations, whereas Austin, for example, has gotten a lot of the tech relocations, but Austin has become super expensive. The infrastructure is really, they don't have the infrastructure for all the people. Houston is a kind of a one-trick pony with oil being such a major part of their economy. It's the other thing. One more thing about Dallas, and then I promise I'll move on to something else. But the makeup of this MSA's industry representation is as diverse as any other major MSA that's not called New York City. Okay, there is no one industry that drives the ship in Dallas, and that has served us very well as we have dismounted extremely well in market corrections, especially if you go past the S&L crisis of 1986. That was a huge. There was an 8.5 year slide, but we got smarter about how we build, about being more disciplined as a development community, and you've seen each market correction get healthier and healthier and healthier, and the amount of months of negative absorption get less and less, and the amount of months of quoted rents going down getting less and less. So I also feel that that we continue, as a young market, we continue to get smarter about the amount of development that we'll do in every cycle. And the areas that I'm looking in particular, you'll see that there's very little to no development in the last 2 cycles. I don't want a bunch of, nice, neat, pretty stuff. I want to compete against people that are not spending money in their assets. So yeah, I do think that Dallas will continue to be a very favorable market as there's some continued fallout from this, and where Dallas does struggle in these times, it's a complete exodus from the AA and AA product. It just those. I mean, you do not want to be caught holding the hot potato on like top submarket A+ and AA product.
Yeah, it makes a lot of sense. I mean, that's a good segue then into sort of, when you acquire these assets, obviously one of the benefits of office is that the leases generally are longer. But how do you assess, and then obviously in your case, you guys are doing some, it's value add play. I mean, you're going to make that building a lot better than it was. So, I mean, just how do you approach that, if there's, are you looking for more expiring leases so that you can quickly, bump the rents, and maybe those guys move out because they can't afford, $28? How does that kind of work?
So that is a great question, Lance, because it's something we spend a long time looking at. If somebody has a healthy rent roll, which means that there's no more than, say, 20% exposure in any year in the first 5 years of the hold, that is a green light. Okay, if 18 months after the hold, you have a 6-month period where 45% of your building rolls, and you're going to be getting done with CapEx, and those folks are paying $7 less than what you project to be charging, you've got yourself a problem. It's something you can underwrite for, but you would rather not underwrite for it. So the way that we look for that, all right, and then the way that we structure our leases, we try to produce a rent roll that's pretty flat. As you look forward, I don't want for there to be 50% roll in 1 year, because who I sell this building to, if they're smart, they're looking at that, right? Mm-hmm. And so you're going to take the right deal. And if we go and get a bunch of 7-year deals, that's fine. That's good. But we have to be smart. Maybe some of them become 6-year deals. Maybe some of them become 8-year deals. Like, we can work with the tenants to get to create a healthy rent roll. And so it's something that we put a lot of attention to. I'm always looking at the rollover schedule when I assess an opportunity. And then when we get a year in, I look at the rollover schedule moving forward and say, are we being good stewards of this opportunity with respect to how the leases roll? When we buy these Class B repositioning, we will typically, account for a higher percentage of expirations of the existing tenants than the market would consider. Market will usually account for 20 to 25%. In the first 3 years, we'll usually account for 40% of the existing tenants not renewing. Now, in the last 7 projects that we've done, our renewal percentage in the first, let's call it, 18, 12, and 2 months is over 90%. And one of the ways that we've been able to do that is the new leases. So if you take the last deal that was done in a building, let's say it's $17 plus electricity. Uh-huh. The new leases we'll be doing, after a year of CapEx is done and it's all pretty, those deals will be, let's call it 25 to 30% higher than the last deal that's done, but we'll bump our renewals like 8-9%. So if we can continue to bump those renewals up a little bit and keep that occupancy, usually we're having to spend very little money to keep those folks. We can increase the rent. We can get much higher rents on the new deals. And so it's a little bit of a game there of, do you want to really lose 50% over going and getting every cent that the market will bear for a new deal? Or do you want to be smart about it, spend $2, $3 to repaint their space and go and get $1.50 bump over what they were paying before? Because in my mind, because I'm always looking at how fast and how much capital am I returning to my investors. that deal of bumping the rent $1.50 and doing new carpet and paint for a 3 or 4 year deal, that's going to have as good a returns as that new deal that I'm doing at a higher rate. When you cap that income, you there's a little bit of on the value side, you're giving up a little bit, but the cash flow is really good, and you're usually doing a lot better than your underwriting on the capital spend. So you've got to look at it. You really have to look at your renewals and your new deals separately when you're repositioning a building. Otherwise, you can fall into that trap of going and losing, 60% of your existing tenancy. And then I guarantee you haven't underwritten enough money in your TI bucket with your lender to go and to re-tenant those spaces. And a lot of people have gotten in trouble that way. So it's really a great question, Lance, because these are some of the things that a lot of people will not look at. They just say, okay, well, if I'm getting $23 from new tenants, then that renewal has to be at $23. Right. No, it doesn't. It does not. Yeah. You can make a really good decision by making that deal at $20. Make the lease short. Give them a 2-year renewal at $20 as is. I'm going to get another bite at that apple in 2 years, and the asset will be even better. Yep. So, people go in with a very rigid view of how these things should go. And while we are very granular and we have a way of doing things, rigidity cannot be part of the mindset when it comes to working with the actual people at the decision-making level. Right. You have to listen, and you have to understand what the situation is. And usually you can find a solution that's going to work for you and for them, especially with the renewing tenants, because there isn't an asset that we've either helped a client buy or we've bought for ourselves where the rents aren't a lot lower with the existing tenants than where they will be when they renew. But we have a really good track record of renewing those folks because, they feel like they're getting a deal and we're not having to spend a lot of capital.
Yeah, that makes a lot of sense. I think too, in the conversation we've had before, you talked about sort of the spec suite, because does that kind of go hand in hand with that? Is that to the degree that when you try to replace those outgoing tenants, and then they're going to come in and they want to make it their own and they want to spend a bunch of, there's a bunch of TIs that have to be done. And so you mentioned that there was something to that. A lot of owners of office buildings are sort of against, spec suites. So maybe you can give a little color on, what a spec suite is and, what how you kind of look at them.
Yeah. Thank you for making that segue, because spec suites are a really big part of driving occupancy and driving rents, repositioning your building. So we have had the opportunity to buy buildings on a couple of different occasions because a large tenant will move out of a space, leave it in pretty tough condition, and that owner will say, well, I'm going to replace that 30,000 square foot tenant with another 30,000 square foot tenant. Even though the asset that they own is 35 years old and it has somewhat antiquated floor plates, it's not efficient, and there's 10 options in the market that have perfectly rectangular, a low common area factor where they get more juice for the squeeze. So you say, well, no, come hell or high water, I'm going to replace that with a 30,000 square foot tenant. No, you are not. Okay. The likelihood of you winning that deal over a 10-year-old asset after things got really efficient that will go and maybe be $2 a square foot higher, $3 a square foot higher, you're not going to win that deal. So the quicker that you realize that you can go make a lot of small to medium-sized deals with good credit tenants, the quicker that you're going to see success. And so here's where the spec suite, the reason why we do these, and I'll go back to what a spec suite is, all right? So when we look at space that's in rough condition or, maybe on the lower floors of a building, instead of just leave it in the condition that it's in, what we will do is we will go and design a large chunk of space. Usually we like to do anywhere from 15 to 25,000 square feet at one time because the economies of scale on the construction side get really good. Mm-hmm. And so we will go with our space planner and we will design those spaces and we will build them out between 800 and 2,700 square feet, depending on the market. Some markets you can go from like 800 to 2,900. Some markets are 700 to 2,500. Again, data geek here, but different. Like when we go into LBJ, for example, you're going to be 700 to 2,700. Central Expressway north of LBJ, you're 800 to 2,700. The tollway, lower tollway, you're going to be 800 to, you can even go up to 2,900. But these are the honey holes where people under those square footages and above those square footages, people don't like to go through the process of designing their own space and working with an architect and picking out the materials, and they are running a business. Every ounce of their day is how can I do better in my business for my employees, for my family. They're not thinking about any of this, and it's a pain in their ass. Okay. So what we do is we go and we design it for the masses. It's what I always say. We're designing for the masses. Because of the buildings that we work in and the size of tenants that we work with, there's nobody that knows what these small to medium-sized users want in the layout of their space than us. And so we're going to go work with our space planner. We're going to design these so that they meet the needs of the highest percentage of small to medium-sized users. We're going to build them out all at once. We're going to get those economies of scale, and we're going to hit the market hard. And so here are the statistics. And I just did a report yesterday on this. So our last two spec programs that we've done, by the time we delivered the spec suites in one of the programs, 27% of the square footage was already leased before we even delivered them. In the other program, 37% was leased before we even delivered them. In the one where 27% was leased, 90% of the square footage was leased and occupied within 90 days of delivery. And in the other program, 100% of the space was leased and occupied within 90 days of delivery. Our construction costs on those, so I take broad, okay, this is what we spend on spec suites. This is what we spend when we let the tenants come in and design their own spaces. Depending on the market, there's anywhere from a 12 to 18% difference between what we spend when we build spec suites and what we spend when we allow the tenants to make those decisions. Because tenants will spend your money in all the wrong ways. They will design goofy spaces that they think conceptually are going to work. But when you get that back, if you get that back, it doesn't work. You're going to have to go and spend a lot of money in construction to get that back into a condition where it can lease. Whereas the re-tenanting, when we lose a spec suite tenant, is almost immediate. I mean, in 60 days afterwards, we have over 90% of our spec suites are re-tenanted within 60 days of move out. You never get that on second gen space. And so again, I go back to give the people what they want. I'm the product of two small business owners. I'm a small business owner myself. I know how little time I have to think about our lease space. And this is our business, right? Yeah. These folks under a certain size, they do not want to make these decisions. Make it crisp, make it good looking. I mean, have the data wires run, make it so they can plug in and work, right? And they will buy what you're selling, and they won't negotiate the price much because okay, what's $1 a foot to a 2,400 square foot user? It's $200 a month. Yeah. Convenience is worth a lot more than $200 a month. So over the 6.5 years since we started the brokerage company, every single one of our clients on the third party side, whether they resisted it for 2 years or 2 months or 2 days, they have come around to doing spec suites, and we've been able across our portfolio to greatly increase occupancy for our clients by taking these spaces that otherwise would have sat there. You see this all the time. Spaces will sit there for 5 years, and people are like, how could it sit there vacant for 5 years? Well, you didn't white box it. You didn't spec it out. You left it with the same raised flooring from the, in the big Liebert units right in the middle of the space. Like, what do you expect people to do? Yeah. People can't envision it. You have to lead them to water. And if you do that effectively, they will buy what you're selling. So it is a big part of what we do. Especially if we have a building where we need to reposition it in the market, which is all of them, by the way, and reintroduce it to the brokerage and direct user community. As we're doing CapEx, we're also doing spec suites. So we can get more brokers in the building to see the CapEx. We can get more direct users in the building to see the CapEx and the amenities. And usually, there's a first responder rate. So the first couple of spec suite deals we'll do at a lower rate. And then you just tick those up and tick them up and tick them up. And all of a sudden, by the end of your first CapEx implementation, your first round of spec suites, you've gotten those rents up for your building to a place that is usually year 2 or 3 in your underwriting. Yeah. And that's the thing that, when we look at return of capital, how fast and how much, spec suites really allow us to get people in and paying fast and increase those rents at a lower capital cost. And I can find very few things wrong with that approach.
Yeah, no doubt. Yeah, makes a lot of sense. So, I mean, in your opinion, if you had to pick kind of the top thing, how does one really get, you mentioned, one of the stories, but, how do you get crushed what's the number one thing that'll kill you in sort of a Class B value add play? And where's the number one fatal mistake that many people make that if when you look at a deal that you go right to kind of scrutinize?
So a lot of people think that you can buy a broken building and the number of dollars that you spend on CapEx will relate to the number of dollars that you can get in rent. So we have a really beautiful asset that is a half a mile from the asset that I just purchased on LBJ in June, and a group out of New York that had first acquisition in Dallas. They purchased this asset, and it's 240,000 square feet, and they spent $10 million on CapEx. Okay, their acquisition basis wasn't great, and then they spent $10 million and said we were going to turn this into a Class AA building. Well, what they ignored was the fact that nothing in that surrounding market would support the rents that they would have to get after spending this $10 million on that asset. And so just because you spend $10 million does not change a market. Yeah. You have to be keenly aware of where the ceiling of rents are for that market. And it's not a bad thing to be the one pushing that ceiling a little bit. Yeah. But if you try to push it by $3 a square foot, you are going to find that everyone's going to say, that's a beautiful building, but we're going to go next door because we can save significant dollars.
Yeah, yeah.
And we can hire more and we can grow here and we can do X, Y, and Z. So I see a lot of folks that will come in and they will hire a project management company that doesn't have experience in this and has experience in more core markets. And they will get sold on a $7, $8, $10, $12 million CapEx implementation. And it will ruin them. Mm-hmm. It will absolutely ruin the investment because you had something that you could have spent $3.5–4 million on, and it would have been fantastic. And you could have, shooting fish in a barrel at that point, right? Yeah. But you spent 10, and now your basis is so high that your lender won't let you do any deals, and you are completely hamstrung. And so, if you aren't vigilant about controlling your basis in this game, then you will get your head chopped off. And do not fall into the trap of the amount of CapEx that you spend is going to relate to the amount of rent that you can get. It's how much do you stretch your CapEx dollars? How smart are you about it? How prepared are you at closing? So that would be the number one way that you can get your head chopped off. If anybody brings you a packet, they say we're going to buy a building for $80 a foot and we're going to put 60 into it, I would look very closely at where that $60 a foot is going.
Yeah, that makes a lot of sense. Yeah, I mean, I think, for me, that it just shows you that when you really get into it, that real estate is a local thing. I mean, there's a reason why they say location, 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 right? And it's just there's so much real estate. I mean, in the grand scheme of things, it's everything, right? I mean, we're doing our best to put a building on as much of it as we can, and it's just the amount of moving parts involved in the intimacy that you have to have, with all of those nuances in a local market. And I mean, with yours is a great example of just, you can just sense the efficiency that comes from the vertical integration, right? Because, the leasing and the property management and, and the ownership and, all of those things is really, what it takes to execute, I guess, especially in these value add plays. I mean, when you're trying to reposition an asset and, which is great. There's an opportunity obviously for tremendous value creation, but yeah, I mean, in terms of the risks that we touched on, we didn't even get into depth onto, the effect that leverage would have or any of those things. I mean, you make a misstep and it does seem to always come back to, controlling your basis. I mean, you got to get in at the right price. And like you said, and the dollars that you put in, you better be damn sure that they're going to generate the value you expect, and just how much on point you have to be on the strategy, and even pointing out the brokenness of the contracting side of it. And
oh yeah,
right. I mean, which is just, we all kind of know that. I mean, there's all these people that are involved, and a lot of it just stretches time gets stretched out. And, I mean, I'm more of kind of on the metric side as well. I mean, I know one thing is that time kills IRR, right? The longer it takes. And that's what you've been harping on, this entire time, is just, you've got to get things moving so that you can generate cash flow, so that you can get the money back in the hands of the investors to really hit your marks. And if you can't do it, those delays will make that, that pretty pro forma where everything, like you said, was just rigid and just clean, get destroyed in no time flat.
Well, you bring up, Lance, the real place where you can get your head chopped off in this is the second that you forget why you're doing it, you can lose sight of the big picture very quickly. If you forget that you are here to be a great steward of capital and you let anything else get in the way of that mindset, that's where I see people make big mistakes. Look, if you go out and you raise people's money, they give you money and you sell them on an execution plan, you do not have the right to change that execution plan unless it's something that the market warrants and you've discussed with your investors, and it is a collective decision. But don't think that just because you don't want to spend that money and execute on the plan that you have the right. Those people have entrusted their money to you. And the second that you forget why you're doing this, you can get off the rails very quickly. And so it's something that with our team, I have to say this, I'm infinitely blessed with an incredible team between our 4 companies, our 22 folks. We just have a really tight group that I feel like they look across the table every day. Like, how can I work hard to benefit the person across the table from me? How can I work a little bit harder to protect that investor capital, to stretch those capital dollars? The efficiencies in our construction team and how they've been able to execute and make municipal relationships and all the things that it takes to execute with more efficiency. I'm really so proud of our folks because they have bought into the message of, we are here to be stewards of capital and not service providers. The days of being service providers is behind us. Even on projects where we don't have an ownership interest, where we are just in a third party capacity, we are stewards of those, of our clients' investors' capital.
That's right.
And I think that message is not preached enough. And it's hard to, when you go and hire out third party all of your services, because the service world between brokerage, management, and construction, it is built to make those 3 contentious. Okay. Yep. The manager's always on the contractor, and they're always in the brokers are like, why can't you get this done fast enough? And the brokers and managers are always fighting. Yep. I lived there for a long time. It shouldn't be contentious. It doesn't need to be contentious. You need to have a unified front when you go through a project like this. And so that is really the secret sauce to what we do, is that we have folks that buy into that understand the process, that are a part of the process, that can every day become more part of the process. And so that's something, I'm glad you brought that up, because people forget why they're doing it more times than I'd like to admit. And clients of mine have done it. And we have to be vigilant about remembering that we're stewards of capital first.
Yeah, and that's one of the things for me too. I say to all the guests that we'll bring on the show is, I'm like, if you still believe that there's some secret sauce that you can't divulge, I'm like, you can't be on the show. And but for me, it's like, growing up, I was a fan of those Nebraska Cornhusker teams. You knew what they were going to do, but you couldn't stop them. It was all about the execution, and it's all great things. It's like having, being a visionary guy, or, I'm strategic or whatever. It's like, that's all great. You need that stuff. But at the end of the day, it comes down to execution. And, I think that's that's at the heart of sort of everything we talked about today, is that it's all fine and dandy, but you've got to be able to execute, and you have to be ready, and you got to plan and know what you're going to do. And that's ultimately, this is how you mitigate risk. I mean, and these are everything we've talked about today. Those are all risk mitigation strategies. It's all about how do you remove something that can bite you, and it's about planning and solid execution, which of course is done by, and has to be done by, competent, humans, right? That work together in a team, right? And so, like, as you said, unfortunately, there's an inherent sort of misalignment between many of the parties. And, I know for me on a daily basis, helping, guys structure investment funds and those sorts of things, it's what I'm always looking at, is that, we've got to figure out a way to create the most optimal, alignment, so that everyone's, but there's always going to be conflicts, right? And so it's like, but being aware of what those conflicts are and how they'll be handled, and, all those things have to be contemplated to try to create, win-win-win situations. So.
Absolutely. Yeah. Every bloody nose produces, if you pay attention to it, produces a little bit more self-awareness.
Yeah.
And that's one thing, just personally, in my own professional maturation, I at first, when you have failures along the way and bloody noses, which you're going to get every day, you can either learn from it, or you can become bitter or whatever. And I found over the years that approaching a project, that there's going to be conflict between the different parties. Let's get that on the table.
Yeah.
Let's use the experiences that we've had. Let's use all that to be more self-aware, both as individuals and as teams, to understand that these things are going to happen, and we need to talk about them early and often. And if we do that, we have a real shot at being dangerous on the execution side.
Yeah.
And we talk a lot about the mental health aspect, the self-awareness aspect as professionals, because those details cannot be overlooked. If we're just out here just doing a job to make money, I mean, give me a break, okay? That's not, it's nice,
not sustainable,
but it's not sustainable. So I think one of the reasons why our teams have been able to build the type of cohesion and unity that they have is we have really tough conversations. I mean, I'll tell them when I'm having a tough day and why, and when I make a mistake, I'm going to let them know, and so we can learn together. And so having that environment where failure is not a bad thing.
Yeah. We
have to mitigate risk. We got to make sure that, they aren't the big ones, but we kind of celebrate that, and we learn from it. And if we can learn collectively together, it means that nobody has to be scared of swinging hard.
Yep.
You have to be smart about it. You have to be prepared. But if you are prepared, and you're passionate about what you do, you can swing hard, and you're going to land on your feet.
Yep.
Almost every time.
Yep, I agree. Well, it's been great, Ben. I really appreciate spending the time today and getting into it. And I think it was great, very insightful. I think, I took a lot from it. I'm no expert, so it's good to kind of hear all the little ins and outs of things. So I appreciate it.
Well, thank you so much for your time. As always, man, I love talking to you, and I look forward to talking to you again soon.
All right, man. Take care. Have a great day.